Alrighty, good afternoon and welcome to the Treasury Partners 2021 Investment Outlook webinar. My name is Beth Moore and I manage communications here at Treasury Partners. That means I'm responsible for herding the entire team and most challenging, getting Rich to do webinars like this. As we turn the page to the new year, today's webinar is truly well-timed. The news cycle is running fast and furious, and so much is influencing markets and where to be invested. With that in mind, I'm pleased to introduce you to Scott Gamm, Managing Director of Strategy Voice Associates. You may recognize Scott from interviewing Jim Cramer daily from the floor of the New York Stock Exchange. Previously, he was a markets reporter at Yahoo Finance and Forbes. Scott will be interviewing Richard Saperstein, Chief Investment Officer of Treasury Partners, to discuss our outlook and our key influential investment themes for the coming year. Richard is a Barron's Hall of Fame advisor and is ranked 6th in the country on the Barron's Top 100 advisor list. This time of year, you can find him constantly monitoring the markets and keeping an eye on snow conditions. And now, Scott, I'll turn things over to you to begin the webinar.
Well, Beth, thank you so much. Great to be with you. Great to be with you, Richard. Happy New Year to everyone. And Richard, we'll be discussing your 2021 outlook over the next 30 or 45 minutes. But I'm curious to hear your reaction to 2020, a historic year for markets, for the globe. We had the fastest descent into bear market territory back in March. Who could forget that month? You've been helping clients navigate markets for decades. What were your reflections for the markets and just for your company, for society really, throughout 2020? Let's start there.
It's a big question. And first of all, I want to thank everyone for joining today. It's the new way of communication. Just a few housekeeping notes. I'm going to really focus on our investment process, what we're doing, why we're doing it. I'm going to be showing some slides. I'm unable to send them out. We can't repurpose some of the material that our research providers let us use. One compliance note, everything that we say, all views are subject to change without prior notice. Hopefully I won't be clunky in using the screen share, and we'll keep this interactive. I see the emails coming in. If you have any questions, you know where to get me. But look, 2020 was just incredibly sad with the pandemic and the human tragedy, 350,000 people dead. We've got now 3,800 people dying every day from the COVID. Keep in mind, 9/11 is etched in my mind. We had 2,977 people die that day. So, the death rate is high. It eclipses 9/11. I have firsthand experience with the COVID. I got it in March. Not a pleasant thing. And I coped with it and I'm still here. So it's very sad what's going on. Economically, we just hit a wall. GDP dropped 30%, came back 30%, absolutely crazy, but there's bankruptcies and massive unemployment still. We've got 14 million people unemployed today. Pre-pandemic, there was 5 million. So we had the lowest unemployment rate, 3.5%. Go to the highest within 60 days. That's just under 15%. I've never seen that in 4 decades, low to high in 60 days. Our lifestyles have changed. Culturally, we're changed. The social distancing, the way of doing things has completely changed. College kids, we held our college symposium 2 days ago. We normally do it in person, teaching kids about wealth management. We had to do it virtually. It just wasn't the same. So their lives are on hold. Their jobs opportunities are on hold. So there's just tremendous impact from the COVID in 2020. The government stepped in, spent $10 trillion, which put it in perspective, that's 50% of GDP was spent on fiscal and monetary stimulus. The government ran a deficit of $3.3 trillion. That's roughly 15% of GDP. Just to put it in perspective, in '08, the deficit was 6% of GDP. So massive government intervention. That all had to be funded with treasuries and more debt. Our practice, Treasury Partners, 26 people strong. We haven't seen each other. We're disseminated throughout the country. We've got people, working on off their kitchen tables, couches. We're fortunate because our business recovery plan was shaped after 9/11, and we've always budgeted and reinvested in software and the latest technology. So we were able to continue, needed to buy some laptops, but we're in good shape. And unfortunately, I can't say that about everyone else around us. The markets were just crazy. What's going on is crazy. I mean, I just thought 2020 was over. I mean, when is it going to end? The S&P declined 34% in a month, okay? That's like $10 trillion worth of value eroded from, the market value of the market and investors' wealth, which is very, very significant. I'll just pull up a chart here, and hopefully you guys could see my mouse, but just to compare that historically, if we go back 40 years, you'll see that the average decline in red is roughly 14% in the S&P, and roughly 70% of the time the market is positive. So in 2020, with all this incredible volatility and disruption, we had a 34% decline, and the market finished positive, 18% S&P total return, including dividends. So relative to historics, it was a very significant decline, you can see here, and we finished up. So extreme volatility, and I can't help but think about when oil went negative. Oil was negative in the futures market in April 21st. Just an amazing year in 2020. And just while we're on oil, in '08, oil was 15% of the S&P, collectively, all the oil stocks. Today, it's only 3% of the S&P. Bonds had similar volatility. I mean, the Treasury went from 142 basis points down to 50, the 10-year Treasury. Corporate bonds last year, there was a point where BBB corporate bonds, take GM, was yielding 10%, okay? And we'll talk about, we got incredibly aggressive on the bond market during that period, but just an amazing year. Some quick reflections.
Yeah, pretty incredible, Richard. And you talk about the drawdown we saw in March, and I think if we all remember the week before that Monday, March 23rd low, where the S&P 500, the Dow were dropping 10% really on a daily basis, and yet you guys maintained full equity positions throughout 2020. I'm curious what factors led to that, because clearly that was the right strategy given the rebound we saw since the March lows.
Yeah, look, none of the decisions we make are easy, but we have to have a well thought out reasons for applying these decisions. And the way we looked at COVID was it's going to cause severe contraction in economic activity, leading to a recession, leading to lower rates. But from an equity perspective, it was a transitional event, not a structural event. '08, we had a structural event in the great financial crisis. Okay, that was a different event than the COVID, which we had confidence in science and we had confidence that it was going to be transitional. Not to mention, going into the event, we had incredibly great economic foundation. So household net worth was $130 trillion. The consumer, which is our US economy, is 70% consumer spending, the GDP. The consumer had and currently has the lowest debt service ratio in the last 40 years. So it's down to 8%. So the consumer wasn't leveraged. Unemployment was at 50-year lows at 3.5%. So it was an incredibly strong economic and vibrant period when we went into the pandemic. We thought it was going to be transitional, and as long-term investors, our view was we're going to hold on to the stocks, but we saw incredible opportunity in the bond markets when bond prices plummeted and yields went up, and we thought that this pandemic would lead to an economic contraction and lowering of rates. We immediately started buying bonds. We just were buying every single day. Shout out to the team for what we accomplished, the amount of bonds we bought in such a short period of time, executing transactions, settling trades, reporting on trades. It was just an incredible period of hard work for the team, and I've got to shout out to them. But we took great advantage of that. We bought corporates and municipals that today, just 8-9 months later, they've appreciated anywhere from 8 to 20%. So our view was, let's hold the equities and let's take advantage of the bond market.
And talk about the typical client asset allocation, because I would imagine you were set up as well as possible heading into this crisis, just from a, I guess, philosophical perspective.
Look, we use a foundational approach we call 3D, three-dimensional. That being said, we have clients with 100% bonds and we have clients with 100% equities, but the typical client has a three-dimensional portfolio where there's bonds, equities, okay, which we call market-related, and then less market-related investments, which are hedged investments. And look, we measure everything using basically correlations, and we look at everything correlated to the S&P. And what we want to do is identify what the correlation of various investments are to the S&P, and secondly, what the up-down capture ratio is. So when the S&P goes up, what are the ups that are captured in that investment? And when the S&P drops, what is the capture ratio in that declining market? And what we do is we layer these three components in these three dimensions: bonds, market-related stocks, and hedged investments, based on a client's risk return and how much correlation we want to have with the market. So we went in there, a typical client would have, let's call it, plus or minus here, 25% fixed income, 50% equity, and 25% in hedged investments. So at the lows, the March 31st measurement period, market was down 18%. Our average capture ratio was 70% of that. We're down about 13% plus or minus. And we just finished the year, the market was up 18%. Average, we're up about 16%. So we have 90% upside capture on the year and roughly 70% downside on during that period. Look, we weren't happy when client portfolios were down 13%, but the methodology we applied actually was effective, and the logic worked, because if we apply our historical measurements of up-down capture and correlation in the three buckets, it should work, and it proved itself in 2020.
So just to be clear, client portfolios not down as much as the broader market in March, but then we're able to capture most of the, if not all, the upside in the ensuing rebound after the March lows. Was that directly attributed to the three-dimensional strategy? Were there other factors at play?
Yeah, our managers had a really good year, and part of it has to do with, the portfolios are set up with ETFs, exchange traded funds, which capture 100% of the upside of the market, but also 100% of the downside of the market. And one of the tactical shifts that we did was we normally run about 40% ETF, 60% active management within that second dimension of market related equities. So one of the outcomes of our analysis of the pandemic was, well, wait a minute, we're holding these ETFs, but we don't want to hold the S&P that holds, let's say, United Airlines, Marriott Hotels, Darden Restaurants, these names that are going to be really impaired by the pandemic. So we reduced our ETF exposure, probably have it down around 20-25% right now. And so that tactical change probably assisted it. Our managers did exceptionally well. Some of our long short managers, we haven't released the results yet until it takes about 6 weeks till the final accounting's done, but just had incredible years last year. So I think it was a combination of the three-dimensional approach and the performance of the managers and a tactical allocation change along the way.
And speaking of the rebound in stocks, from the March lows, and that rebound really has continued to this very day, even in the face of many other so-called, I guess, uncertainties beyond COVID, right? The election, Fed uncertainty, corporate earnings uncertainties. What do you think were the key drivers of the recovery we saw in 2020 that has, of course, led into 2021? Was it the Fed? Was it the vaccine? A combination of both?
Well, initially it was the Fed, and look, we March 23rd, just remember that date, okay? Like September 15th in 08 when Lehman went under. So there's key dates that are in our minds that we remember. March 23, the Fed came into the rescue. They announced they're buying corporate bonds and ETFs, and after that date, the S&P rose 25% in a month. So that's $5 trillion worth of value that got added on. And, that was an incredible ungluing of the financial markets. Like $5 trillion is equivalent to the GDP of California and New York, the two largest GDP states in America. So the Fed, ramped up their balance sheet. As I said previously, the fiscal and monetary response was $10 trillion. The fiscal portion of it was $3 trillion. So the Fed increased their balance sheet by $3 trillion, and the multiplier effect on the market was $5 trillion. So you had a 1.7 times impact on wealth versus the Fed's balance sheet. November 9th was when the Pfizer vaccine was announced. So that had a further effect. The market went up like 6%. So it added $1.5 trillion, basically added Amazon, okay, the value of Amazon to the market. So dual effect. Fed clearly is there. It's kind of the new way of investing now. Not like when I came up in the 80s and 90s, where the Fed was not there to protect investors and maintain wealth. It's a post-Bernanke doctrine, but clearly that had an impact. And then vaccine now is pushing it forward.
And Richard, we were talking about this a couple of days ago, but just kind of reflecting on the numbers of 2020 for the year. Right. So forget the March low, but for the year of 2020, S&P up 16%, NASDAQ up 44%. I mean, I don't even know what the right question to ask about that is. Perhaps just, were you surprised by that?
Yeah, I'm surprised. Yes and no. I've been surprised, like starting in Black Monday in 1987, and getting hammered in that one. So each one of these puts another chink in the armor and makes you think. And most important, it guides our thinking going forward as to what the risk is and volatility is of being an investor, and also how to navigate the volatility. So we try to use what is occurring proactively into the future in just generating better returns. So yes, it was crazy. Was I surprised? Yes, but no, because I've seen some really crazy stuff going on. When you think about what happened after Lehman went under on September 15th, in '08, before TARP came out. I mean, the financial system was like really unsettled. So just another event for me to learn from. Learned a lot this year in the markets, and this is another one.
Yeah, no, well said. And as we kind of shift our conversation to 2021, how are you feeling right now about the markets? Would you say we're due for a correction? In the white paper you released to clients a couple of days ago, you mentioned worries about valuations, and I'm wondering, how you would unpack valuations in terms of where they stand right now.
Yeah, the market's overvalued. If you look back historically, I mean, based on let's say 2020 earnings of 140, it's 26 times trailing. Based on the estimate of like 168 on the S&P for 2021, it's roughly 23 times earnings, and then it's roughly 20 times earnings based on 22 estimates. Now, we think those earnings estimates for 21 are high. So we think the market's PE is actually more elevated than analyst estimates. So when we answer the question, yeah, we think the market is elevated. But that's against a backdrop of a zero interest rate environment. And so how do you assign a PE to where stocks are trading when one of the alternatives is paying nothing? And we'll talk about this later, and you see this shift of asset allocation from fixed income into equity, driving multiples higher. Very important point, which I hope we cover later. But when we look at the market and think about the risks, there's a lot of net selling by insiders, increased margin debt, a lot of call option activity. There's a host of risks out there, but we're maintaining our positions. The Russell 2000, the small cap stocks, they're overvalued also, but we have a proprietary model. They're basically 142% over their 20-year average, whereas the S&P is 150% over the 20-year average on a go-forward PE. So we're actually maintaining our small mid exposure as a result of that. We wouldn't be surprised if there was a sell-off along the way. I was surprised that with the events of yesterday, which are incredibly distressing and disappointing, that the market didn't sell off and bonds didn't rally. So you're in a situation where there's so much liquidity out there that the market is actually pushing through an event like that. 20 years ago, stocks would have been down big, bonds would have been up. Okay, that's not the case today.
Well, and it's almost like do headlines matter less for markets in this environment when you have so much liquidity? I mean, now we have SPACs to worry about, not just IPOs.
Yeah, look, there's a lot of reasons why the market could have a correction. What would it take for me to say, hey, let's add to equities? I think look, most of our clients are at full positions. If there was a correction based on the outcome of successful vaccine distribution, okay, in 22 and beyond, and the pent-up demand for you name it, okay, I think we can have really solid results 22, 23. So we're in a bridge year of 21. If we get a correction, we might bump up exposures, along the way. But we're really focused on things like, what is our sector allocation? So what's our growth versus value tilt, U.S. versus non-U.S.? What's our exposure to technology, life sciences, distressed debt? Where are we extracting small portions of value along the way in what is a backdrop of a zero interest rate environment? And keep in mind that, we're longer term wealth builders, okay? We're not looking for the next quarter or a year. We're looking at where do we position wealth over longer periods of time to grow it.
So with that, Richard, what are the themes that you're watching in 2021 from an investing point of view? Are there themes that emerged in 2020 that you think have staying power for not just this year, but to your point, over the next several years?
Yeah, we got some really, really good themes. We're really excited about. Got good confidence in them. Let me share a screen again, and I hope you guys could see this. I don't know. Send me an email if you can't. All right, I got the email up, or send Scott an email, or Beth. Anyway, so first of all, before I get into this growth versus value, we'll call it conundrum. Let's talk about U.S. versus non-U.S. And everybody knows that since the financial crisis, we've had basically zero emerging market exposure and a very small toehold in one international manager. I won't say the name. So if we look at the results here, last year, you can see how the S&P was up 18, and let's call it the Euro stocks down 4%. Emerging came back at the end, 17%, okay? But when you look at longer term results, 3 years, 5 years, 10 years, like since the great financial crisis, you can see how the S&P just has blown the doors off all these other investment opportunities, these other markets. And so we sit in our meetings and say, listen, is this going to be better than the S&P? We've got to have high confidence levels that the vol, the upside downside capture will be better, okay, correlations and everything, to add anything other than the S&P. And that applies very, very strictly with emerging markets and non-US equities. We talk about growth versus value. Last year, you can see the huge outperformance of the growth sector. This is the Russell 1000 growth index versus the value index. Keep in mind, 40% of this is 5 stocks, okay, the big 5. But if we expand the time frame, you can see how the growth has eclipsed the value over 3, 5, and 10 years. Now, why is that happening? Okay, we're going to get to that. But what the result is that the relative PE ratio of growth versus value is starting to expand. Okay, so this basically takes the middle line is the Russell 1000. All right, growth and value, the basic middle of the road, segments out the growth stocks and the value stocks. And you can see how the PEs are elevating in growth versus value. And it's not only happening in the US, it's happening globally. So we got to think about what's happening, why is it happening, does it make sense, is it overvalued? So the top 10 stocks in the S&P now represent nearly 29% of the entire S&P. So you have to step back and say, wait a minute, like, is the bell ringing like 99 and 2000, right? The tech bubble. And the reason why we don't think it is because the earnings are there. So if you look at the earnings of these top 10 stocks in the S&P, it's 24% of the entire S&P's earnings. So you have a situation where there's what we have been calling scarcity value in the growth sector. And this is a recent phenomenon because if you go back 70 years, you're going to see that value outperform growth for 70 years. It's only until we started to see the emergence of technology and the application of technology that this started to change. And it's been accelerated dramatically, really incredibly, with the pandemic. So you can see how the ratio, and this goes back 70 years, has changed relative to the growth to value the ratio. And why is it happening? Well, if you look at today, and you want to have a clear definition of growth, because everyone talks about growth indexes, growth stocks. Well, if you take the number of stocks in the S&P that have grown the top line at 15% compounded annually, there's only 66 stocks that have done it over the last 5 years. So there's a scarcity of companies that are actually growing in the S&P. That's causing the PEs to elevate, and that's causing, because they're growing, their earnings are increasing, and that's the scarcity value that's occurring in the S&P. So our themes really center on we're overweight growth, and we're going to continue to be overweight growth. It's worked for us. We think it continues. Keep in mind that the pandemic has really accelerated the adoption of growth. So if I talk about our core investment themes, okay? First of all, we see that there's incredible technology that is at the forefront. You think about how we came up with a vaccine against the COVID in 9 months, okay? 9 months, we came up with a vaccine. Normally takes 10 years, okay, to get it through FDA. There's incredible technology that's going to be adopted across all of our lives, and that's going to lead to what we call as the fourth industrial revolution, the onshoring revolution, okay? It's going to lead to a regionalization of production, lower tax rates, and more manufacturing will further stimulate employment here, but it also will adopt artificial intelligence and robotics, which will further accelerate productivity. And that's a trend that's been put in place, very important one that we think continues for many years to come. We also know that e-commerce just had an incredible pull forward. So this e-commerce transformation that occurred in the last 9 months was 5 years pulled forward, okay? This transformation is here to stay, okay? The pandemic has radically altered the way we're operating, and the winners must have an online experience. So we characterize this as a bricks to clicks change. It's going to reboot an amazing number of parts of our lives that we're going to have to deal with this new technology. And you could think about not only online e-commerce, but cloud, software, storage. Look, we're doing a webinar here, and we're not in person with you. There's a lot that's going to stick with us, and it all is going to be driven by and adopted through increased technology, and that's going to lead to higher valuations of these providers. We also see asset light moving forward. So online ordering, schooling, telemed. This transformation is accelerating and will only continue. And we must have representation in our client portfolios. Homebodies need homebodies need minutes on Sunday night at whatever time it plays, and then it gets delayed because of NFL football, which is kind of a little bug of mine, all right, which we haven't been able to solve in our household. But we're going to go more on demand, okay? Subscription-based services. It's going to happen. The trend started. It's going to continue. So that's going to call for more studios, films, gaming, bandwidth. All that's going to be pulled forward, and it's got to be represented in client portfolios. One of the biggest trends, it hit me like a ton of bricks. Okay, I don't play much golf, but play a couple of rounds. Invariably, I lose 10 bucks, 5 bucks, 20 bucks. I used to give out cash money. No more. It's Venmo. Okay, so this dinosaur is now on Venmo. Okay, so I got Venmo now, right? But I'm not the only one, right? The whole payment processing chain is changing, meaning there's merchant acquirers, there's payment processors, there's the credit card companies. They're going to have the number of transactions increase dramatically over the next decade, right? Cash money is going away, right? So we expect that trend to continue, as well as the last theme, which is urban to suburban. And, we're not calling for the death of urban centers or densely populated, but we're seeing densely to less dense populated living, okay? The cities are the hubs of educational, cultural, social, scientific centers in America. That is going to be there. It'll never change. But what we're finding is that there's been a dispersion from urban to suburban. We think that continues. All right, the impacts are going to be commercial real estate gets converted to residential, zoning changes, the suburban effect. We're seeing it. Everyone is seeing it now. Like, honey, the carpet is shredded. I'm tired of it, and I want to replace it. Done. Okay. It starts there. It goes all the way up to the addition, maybe a pool, but we're remodeling. Lumber prices are up 100% year over year. So this trend is going to continue. And it's very important that clients and their portfolios are represented in that area. Those are the themes we're really focused on.
Well, and maybe this is not a portfolio related theme, Richard, but you were also telling me your adult kids are back home. Another trend that's been going on, not many families across the nation. How has that been going?
It's just incredible. Like, listen, I think they're on this call today, but I got to tell
Okay.
you, like the greatest benefit of COVID for me is, like having the 26 and 24-year-old, hand the keys back to the landlord, come back home. And it's like, I got dinner with them. I get into these arousing, or no, I shouldn't say that, these rousing millennial discussions. I mean, we're not in full agreement on things, but look, it's the family unit is together. It's temporary. I'm sure they're absolutely miserable. Okay.
I don't think we have a feed on them right now.
I don't think so, but we should have had the camera on them. Let them chime in there. But they're working from here. We got the monitors, got the setups, and we're all good. And it's been a big change. So I'm happy about that, as is Andrea, my wife.
All right. Well, glad we cleared all that up. Richard, let's also, as we move to the end of our discussion, there you go.
Little commercial. Can you see that?
Yeah, we can make that out. It's, what it is? It's that ring light, another thing that came up from the pandemic, making that bright.
Okay. Well, it's
okay.
Got put a little commercial in there.
Well, this is a great segue to our last topic, Richard, fixed income. And I know that's kind of one of the last themes you wanted to discuss today. So why don't you just kind of give us a brief overview of how you're thinking about bonds and client portfolios in 2021 after buying so many and focusing on that during the drawdown we saw in March.
The three-dimensional approach has fixed income, market-related equities, and protected hedged investments. And the fixed income, it could range average 25. It can go from 20 to 50%. But everybody now is going to have to address an issue. And that is the reinvestment rate is 1% or sub 1% in some cases. So does the investor want to have a drag on their portfolio, earning basically nothing, or take that safe money and expose it to risk-oriented assets? It's a very important discussion. It's a very unique discussion with each investor. There is no one answer that we can apply to all of our clients. I will tell you that I'm a client of my firm, and I have a three-dimensional portfolio, and I am not changing my fixed income exposure. All right. The reason is that that money is there as dry powder, right? If we expose all the assets to risk or to volatility, okay, and let's bring in another a black swan event. Okay, here it goes. You got the vaccine, great, everything's going well, but the COVID now mutates and it slips. Okay, it slips the clutch of the mRNA or the whole way this thing works. Okay, and all of a sudden we find ourselves back to square one, where we have lockdowns again in, let's say, 22. So what happens in that case? Well, your market goes down, okay, your rates go lower, so right now we're buying, and we wrote about this I don't know, a couple months ago, where why are we buying municipals in taxable accounts? So we're seeing value there again. I mean, just today we're buying 80 to 120 basis points on callable munis, which basically are callable in, let's call it 2023 or 2024. So we're not going out past 3 years, but what happens is if this tail risk event comes in, then all of a sudden you're back to square one. And if you expose your portfolio to risk assets, you've got no dry powder. You got very little flexibility in the portfolio. One of the things I've learned is always maintain flexibility. Now, that being said, there are investors that don't want to be as conservative or kind of cautious as I am, that may want to drive returns across the 3 dimensions. So in that case, if there's 25% bonds, all right, then you take 5 or 10% and you reallocate, exposed to risk, but you've got to understand that it raises the overall risk profile of the portfolio. So it's a very important concept. We're trying to neutralize the risk of rates going higher by shortening up the durations and the maturities of new purchases, and being, we'll call it innovative by buying, this one asset class that we find value in.
Well, we have been getting some questions, Richard, throughout the conversation, and we've covered a lot of the questions that people have been asking, which is great. But we did get one just real quick. Your thoughts on the economic impact of some of the stimulus checks we've been seeing, $600, the potential for a higher one, perhaps over the coming months. What are the impacts that may have on the economy? And then any thoughts on your expectations for higher taxes in the coming years?
Right. So like you can just look at the stock market every day and you're seeing the stimulus checks. All right. So, the liquidity that's in the system right now is tremendous. And, it's measured by something called M2. It's a measure of, the monetary growth. It's growing at like 25% year over year. Normally that's inflationary. But what's happening is instead of that money getting recycled into a multiplier effect in the economy through loan growth, what's happening is that it's going into equities, right? It's fueling the stock market moving higher, building the wealth effect and adding to spending. And it's part of the Bernanke doctrine, which worked after the financial crisis. So I would expect with the blue wave, we're going to see a stim package probably in the $700-800 billion range. It'll probably top off that $600 to $2,000. We'll see aid to state and local governments. But I would expect that right off the bat, probably February and March. With regard to taxes, we're going to see higher tax rates. We're going to probably drop the one that's 37, go from 35 to 39.6. Higher tax on cap gains and dividends. Corporate tax rate will go up to probably 25%. But keep in mind, when that corporate rate goes up from 21 to 25, that's $40 billion. That's going to impact EPS, earnings per share. So, think about that versus the multiple, and we've got to pay attention to that. But at some point, that's going to be reflected in the marketplace. I could see an infrastructure bill that would make sense. Reversal of Trump's deregulatory actions. Think about energy, the financials. I could see energy tax hikes. Obviously, changing environmental control reforms, drug price controls. I wouldn't be surprised to see that. Higher taxes on big tech. So look, there's going to be a lot of changes that will occur, and we're just going to keep our eye on it and navigate along the way.
All right, and then we've got another question, final one, gold and Bitcoin.
What about it?
Is that going to be part of the portfolio anytime soon?
You know, I don't know how long ago it was, but I went to my son, like, I don't know, 2-3 months ago. I said, I want to buy Bitcoin. It was $12,000. He said, oh, you got to go. Never did it. Okay. And, you know, today it hit 40,000. Okay. So, look, I think these alternative forms of wealth storage have a place in client portfolios. Bitcoin, as I understand it, has a limited supply, and you're seeing institutional demand come into it. So I wouldn't be surprised if it continues to march higher. And at some point when my son hooks me up and gets me on the login account to get it done, maybe I will join the party there.
All right. Yeah, I guess the clock is ticking. This thing just, it doesn't stop.
Yeah, 12,000 to 40,000. All right. So, you know, but it wouldn't be the first time I missed an opportunity. But look, you know, in this whole thing, investors have to think about long term. And over the last 50 years, the S&P generated an 11% compounded rate of return. It's positive 16 of the last 18 years, okay, and 40 of the last 50 years. So when building a portfolio, you've got to anchor on what has worked, all right? The US economy continues to grow, all right, irrespective of what happens in politics or military. You've got people, there's families being formed, kids being born, washing machines have to be purchased, okay? All this continues, all right? And that leads to more demand and higher earnings and higher stock prices over the long run. So, you know, that's how we think about things over the long term. And, you know, the historical reference point is how the S&P is done.
Okay. Well, Richard, I think that's a great place to leave our discussion for now, but it was great to be with you. Thank you so much for your insights, and I'll toss it back to you for some closing thoughts.
Thanks, Scott. Just want to thank all of our clients for the opportunity to manage your wealth. Last year was really an incredible year. The trust that you place in us is something we take seriously. Entire team was working 7 days a week, really integrated. Just great thought was put forward. And I just got a shout out to the entire group at Treasury Partners for the work that they have been did during the height of the COVID, dealt with all the changes and disruption. And so I appreciate everyone's efforts. And most importantly, I want to thank our clients for giving us this incredible right and opportunity to manage your wealth. Thank you.